I know you're looking for ways to grow your wealth in 2026. And honestly, the market right now is giving us some real opportunities that most people are completely missing. While everyone's chasing the same overpriced tech stocks, there are businesses trading at valuations that just don't make sense when you look at their fundamentals. I'm talking about companies with rock-solid business models, explosive growth potential, and price tags that seem almost too good to be true. Stick with me because what I'm about to share could seriously change how you think about building long-term wealth this year. Before we dive in, if you're serious about making smarter investment decisions and you don't want to miss any of our deep dives, go ahead and hit that subscribe button right now. We're building a community of investors who think long-term at Stock Vibe, and I don't want you to miss out on the content we've got coming your way. All right, let's get into it. Stock number 1, Brookfield Corporation, BN. The first company I want to talk about is Brookfield Corporation, ticker BN. Now, I know what you might be thinking, another infrastructure play, right? But hear me out, because this isn't just some boring utility stock. Brookfield owns the kind of real-world assets that the entire global economy depends on. We're talking hydroelectric dams, nuclear power plants, data centers, toll roads, railroads, pipelines, and skyscrapers. These aren't things you can just replicate or build overnight. The barriers to entry are massive, and that's exactly what makes Brookfield so valuable. What really gets me excited about Brookfield is their exposure to the AI boom. Everyone's talking about AI software companies, but nobody's talking about the physical infrastructure that AI actually needs to run. Brookfield believes there's $7 trillion that needs to be invested into AI infrastructure over the next decade, and they're positioned to capture a huge chunk of that. They've already announced $200 billion of investments into AI factories around the world, partnering with the biggest tech companies and entire countries like Sweden, France, and the UK. Here's the thing. Brookfield has a 30-year track record of delivering 19% compounded annual returns. That's over 27,000% in total returns. And they're not trying to swing for the fences with crazy 50% annual gains. Their goal is steady, consistent 15% annual growth, and that's more than enough to build serious generational wealth. Over the next 5 years, Brookfield is expecting to produce $53 billion in cash flow. Their current market cap is only $115 billion. Which means they're going to generate almost half of their entire market value in cash in just 5 years. That's insane. Their insurance business alone is expected to triple its earnings by 2030, and when you run the numbers, that single segment could be worth $80 billion, which is almost 70% of what the entire company is worth today. I ran a discounted cash flow model on Brookfield and even using conservative assumptions. The stock could compound at 22% annually with a fair value 67% higher than where it's trading right now. This is a business with clear growth drivers, a proven management team with 20% insider ownership, and a moat that's nearly impossible to replicate. Stock number 2, Mercado Libre, MELI. Now let's talk about Mercado Libre. This company is absolutely crushing it in Latin America, and the market still doesn't seem to fully appreciate what they're building. Mercado Libre is digitizing an entire continent. They're the largest e-commerce platform in the region with 94 million unique buyers per year. They're the #1 digital advertising platform, and they're one of the largest fintech companies in multiple countries across South America. Here's what makes MercadoLibre so special. Their different business segments actually accelerate each other's growth. The e-commerce platform generates data that makes their advertising more valuable. The advertising revenue helps subsidize lower fees for sellers, which brings more merchants onto the platform. And the fintech business allows more people to make digital payments, which expands the total addressable market for e-commerce. It's a flywheel that just keeps spinning faster and faster. Latin America's e-commerce penetration is still way behind the US and China, which means there's a massive runway for growth. The region's e-commerce market is expected to grow 54% by 2028, making it the fastest growing e-commerce market in the world. And MercadoLibre isn't just riding the wave, they're growing faster than the overall market, which means they're taking market share. Their fintech business is absolutely exploding. The credit portfolio reached $11 billion in the third quarter of 2025, up 70% year over year. 50% of small businesses receive their first ever credit offering through MercadoLibre. This credit business is helping sellers buy more inventory and grow their operations, which directly accelerates the e-commerce platform's growth. It's genius. In their most recent quarter, revenue grew 39% year over year. That was their 27th consecutive quarter of over 30% revenue growth. No other company in the stock market has achieved that. The business has 16x'd its revenue since 2018, and it's actually accelerating at scale. When I ran ADCF on MercadoLibre using a 25% annual growth rate and a 20 price dash to dash free dash cash flow multiple, the fair value came out to over $4,000 per share, more than double where it's trading today. If you found this helpful so far, drop a comment below and let me know which stock you're most interested in. And if you're getting value from this video, hit that like button. It really helps us reach more people who are serious about building wealth. Stock number 3, CP Rail, CP. Let's move to CP Rail, ticker CP. Now, railroads might not sound exciting, but stick with me because this is one of the most misunderstood opportunities in the market right now. CP is one of only 2 railroads that operate across Canada, making it a duopoly with CN Rail. But here's where it gets interesting. CP also has access to the US and Mexican economies, and they're the only railroad network that connects all 3 countries. This gives CP a massive competitive advantage. For goods to move from Mexico to Canada on any other rail network, they'd have to switch trains, which means CP offers a faster, cheaper, and more reliable service than any competitor. You literally cannot build a new cross-continental railroad today. The land rights and environmental permits make it impossible. CP owns a bottleneck on North American trade that cannot be replicated. Mexican imports into the U.S. have been growing consistently, and Mexico was the largest importer of goods into the United States in 2024, even surpassing China. The total value of goods traded between Mexico and the U.S. was $840 billion. CP is in the perfect position to capture that trade flow. They're projecting high single-digit revenue growth, but double-digit earnings growth because they're keeping expenses flat while revenue grows, which expands their profit margins. Since 2011, CP's earnings per share are up 630%, compared to Union Pacific's 294% and CN Rail's 200%. CP has grown earnings the most by far, yet it's only trading at a slight premium to its competitors. The stock has been flat for about 4 years, while the underlying business has continued growing, which has compressed the multiple down to a point where I think it's actually undervalued now. When I ran ADCF, assuming 11% annual earnings growth and a 20 price-to-earnings ratio, the fair value came out 17% above where the stock is trading. Railroads are anchors in a portfolio. These businesses have some of the strongest moats I've ever seen, and I'm confident they'll be producing cash flows 100 years from now. A single train keeps 300 trucks off the road, and trains are 3 to 4 times more fuel efficient than trucks. They're critical infrastructure that the economy can't function without. Stock number 4. Shift4 Payments. 4. Next up is Shift4 Payments, and this is a company that's been beaten down in the market, but the fundamentals are only getting stronger. Shift4 is a one-stop shop that provides software and hardware to help businesses operate and accept payments. They specialize in the hospitality and entertainment industries, but they're expanding internationally. What makes Shift4 different from pure payment processors is that they offer a full software solution. They give merchants everything they need: curbside ordering, menu configuration, inventory tracking, loyalty programs, table management, reservations, and more. They often give the software away for free or at a very low cost to land a new merchant. Then they make money on the billions of dollars in transaction volumes that flow through their systems. Shift4 just completed their largest acquisition ever, Global Blue, for $2.5 billion. Global Blue is the king of tax-free shopping, processing VAT funds for tourists. Their customers include iconic luxury brands like Louis Vuitton, Prada, and Hermes. This acquisition gave Shift4 access to over 75,000 luxury retailers with over 400,000 locations and 15 million shoppers worldwide. In their most recent quarter, transaction volume was up 26%, revenue up 29%, gross profit up 62%, and free cash flow up 27%. Every single metric is growing over 20% year over year. They're projecting to exceed $1 billion in free cash flow by the end of 2027. When I ran a DCF based on that guidance, assuming they buy back 3% of shares annually and trade at a 15 price-to-free cash flow multiple, the stock could compound at 42% annually with a fair value over 100% higher than where it's currently trading. The market has been concerned because Shift4 took on over $2 billion in debt to finance the Global Blue acquisition, and the overall payment sector has seen weakness. But as they pay down that debt with their strong free cash flow generation, I think we could see significant multiple expansion. The business is trading at a market cap of around $5.7 billion, which means if they hit their $1 billion free cash flow target by 2027, the stock would be trading at less than 6 times free cash flow for a company growing revenue over 20%. That's a steal. Before we get to the last stock, take a second and share this video with someone who's serious about investing. The more people we can help make smarter financial decisions, the better. Stock number 5. Zeta Global. Zeta. Finally. Let's talk about Zeta. This is an AI-powered marketing platform that helps large companies find, grow, and keep customers more efficiently than traditional software. Unlike many competitors, Zeta comes preloaded with its own massive database of trillions of consumer signals, which allows brands to predict what people want to buy without relying on third-party cookies. Zeta has 2.4 billion deterministic profiles in their data cloud. They use AI to identify high-intent customers even before they visit a business's website. 44% of the Fortune 100 are Zeta customers, including 2 of the 3 largest airlines and 5 out of 10 of the largest insurers. In their most recent report, they had 26% revenue growth, 46% EBIT growth, and 83% free cash flow growth. They've also beaten and raised guidance for 16 consecutive quarters. Zeta gave guidance for 2028, projecting $2.1 billion in revenue and $340 million in free cash flow. When I ran a DCF based on that guidance, assuming 35% annual free cash flow growth and a 25 price-to-free cash flow multiple, the stock could compound at 22% annually with a fair value 35% above where it's trading today. One concern investors have is stock-based compensation, but management has said they're slowing that down and it's becoming less meaningful as the business scales. I think if Zeta hits their targets, this stock could seriously outperform the market over the next few years. Conclusion. So there you have it. 5 stocks that I think are offering serious value heading into 2026. Brookfield for its infrastructure dominance and AI exposure, Mercado Libre for its unstoppable growth in Latin America, CP Rail for its irreplaceable rail network, Shift4 for its undervalued payments and software platform, Zeta for its AI-powered marketing technology. Each of these businesses has strong fundamentals, clear growth drivers, and valuations that don't reflect their true potential. If you got value from this breakdown, make sure you're subscribed to Stock Vibe so you don't miss our next deep dive. Drop a comment and let me know which stock you're most excited about. And don't forget to hit that like button. Thanks for watching, and I'll see you in the next one.